Well, hey, everybody. Today, I'm going to share with you a video on how you can use Delta to identify your sell strikes for credit spreads. All right. We're going to use one of my favorite stocks, and it's one of my favorites because you can use it every single day for 0 DTE, which means you can take in profits every single day, which is what me and my community do. So I want to share with you what I have here. Let's get into it. So here we are on XSP, and we're looking at today's expiration, which for us is September 22nd. I want to show you how to use Delta for your strike selection. If you look at the chart, you may decide based on what's going on in XSP today, which is the mini S&P 500, by the way, that you may have a little bit of upward movement going. So you may decide you want to start with a put credit spread for the day's expiration. So we look here. We're going to look at a put credit spread. I'm going to the trade screen, and you're on Delta. Looking under the put credit spread side, this Delta basically means there's a 0.10 Delta, which means there's a 10% chance it's going to come down to this number. At a 0.17 Delta is a 17% chance it's going to come down to this number, to this strike, which is 433. The 0.3 Delta says there's a 30% chance it's going to come down to 434 by expiration. So now this is where you need to determine your own level of risk tolerance, because if you're one who's okay with 30% probability of the price coming down here, then that's the sell strike you would pick. But if you're one who's a little more conservative and you really want to have a 90% chance that you're going to be successful, then you would pick 432. The one thing I want you to see, though, is when you pick these different strikes, the money's different at these different strikes. Okay, so we're going to look at 430, 434, and we're going to look at 432. So I'm going to the vertical here. If we look at 434, the current premiums you're going to take in as a seller is $16, around $16 per one spread, which is about a 16% return on your collateral. But if you go down and you select 431, 432, as you can see here, you're only going to receive $3 in premiums. Well, you're going to spend $1 and some change with Thinkorswim. You're going to spend $1.50 almost in fees. So that's half of the money that's going to be spent there in fees. So let's look, if we maybe pick in the middle, 433, maybe you're moderately conservative and you want to go here. Me, I'm a little more aggressive, so I'm okay with 434. But let's look at what does 433 give us. Once we select this strike, you see here that actually gives us a little more money than we anticipated. So we're going to collect $9 here, $9 in premiums for our one spread, which means we're going to leverage the other $92 or $91 of collateral in order to take in $7 or $8. Which in many cases is fine. You're going to spend $1.50 in fees. So $5, $6 per contract you're going to go with. If you like this strike price, but you want to take in a little more in premiums, then you can do more contracts, right? 8 times 2 contracts, $16, 3 contracts, $24, 4 contracts, $32, so on and so forth. Or you can decide, I want to go with something a little bit closer. I'd rather go with 434 and 433. I'd rather do that. So now this is going to pay $16, as I said. If you're okay with that $16, you want to make 30 or 40, you definitely need to just do multiple contracts. So I'm going to do here, let's do a couple more contracts. In this case, we're going to take in $15 each. So 3 contracts, 4 contracts, 5 contracts is going to give us 5 times, what, $75? Yeah. Is that $75? 5 times 15? Yes, that's $75. That's a good little return on our money for today. So I'm going to push confirm and send. And when you push confirm and send, it's going to tell you here that you're going to make a profit of $75. Your max loss is $425 because you're leveraging the remainder of that capital. And you can go on from here pushing send. Let's go back to the chart. We do see what we're looking for here is that price will stay above 434, that it will stay higher than 434. In order for our trade to be successful. Let's see what's on the call credit spread side in case you wanted to do an Iron Condor. I'm back to the single chart here in the option chain. I'm looking for the delta on the call side. This 437.5 strike has a 0.13 delta, which says there's a 13% chance it's going to get here, which is an 87% chance it won't. Those are pretty good odds. Or you can go up to 438, which is a 0.08 delta, 92% chance it won't come up here. So let's look, 437.5 or 437. That's a good range in there for deltas. I try to go with a delta that is less than 0.3, but not too much less than 0.3. Because if you go too much less, there's no premiums there. We want premiums. We're trying to make our money for the day, right? So we do want, I like to get, closer to 0.3 delta, 0.25, 0.20. It all depends on your risk tolerance. Everybody's risk tolerance is a little bit different, but I'm liking 437 at this point. I'm going to switch over to the vertical. 437 is our strike here on the call side. These are 50-cent spreads now. This is kind of interesting that it's gone from being a 1 spread to a 50-cent spread right here in this area. That's kind of telling, right? It's always a 1 spread, except for now we've got something that's not a 1 spread. What the help with that? We can take and expand this spread so that way it is a 1 spread, or we can do multiple contracts. I like the idea of making it a 1 spread. What you can do is you can either do multiple contracts at this strike that you like, or you can expand the spread and make it into a 1 spread. I like that idea better. I'm going to make it into a 1 spread there in the second. I took the buy leg and I changed it into 438 versus 437.5. And it turns out that there is $12 we're getting at that strike. Yes, and we did what, 5 contracts? Let's do 5 again, because we can use the same collateral. When you have an Iron Condor, you can use the same collateral for both. You don't have to put in another $500 of collateral when you do it this way, yet you take in another $72. So now we've taken in $157, all using that same $500 of collateral. Alrighty, so I showed you how to use Delta to identify your strikes for credit spreads. All right, be sure to follow me here for more of this kind of information. Like and subscribe, hit the notification bell. We want to make sure that you know when I put videos out. All right, we do 2 things in this community. We stay green and we get this money. Bye-bye.